Hi, everyone. Welcome back to the next installment of Lunchtime Workouts. I'm Derek Taylor, and then Dan Bray is on as well, and he and I are going to co-present today loan sales and co-lender disputes. Leading up to this, most of our discussions have really been more about sort of borrower defaults and what a lender can do when there is a borrower default. This topic is not totally unrelated to that, but it really focuses more on sort of the lender and what's one of the ways that a lender can mitigate risk, whether through selling down a portion of the loan commitment that the lender has committed to make, and or participating out a portion of the loan to other lender or lenders, and the reasons why a lender might do that. And then also, what complications does that create for the lender, so the lead lender, if it is participating out or syndicating a portion of the loan. And then how does that impact the borrower if there is a default and the borrower the borrower's lender has sold down or participated out a portion of the loan? And so maybe what I'll do first is just kind of describe for those who aren't familiar, or just as a refresher, sort of the difference between a syndication and participation and what that really means. So what we're really talking about is I'll take it sort of on the front end from the beginning of sort of a loan transaction. So, as you know, a lender would typically make a commitment to make a loan. So we'll make it, for kind of example's sake, we'll call it a $10 million loan commitment to make that loan to the borrower. And so the lender, if it wants to lessen some of the exposure of that commitment, it could choose to go and sell down a portion of that commitment to another lender, either kind of concurrent with closing, when it closes on the loan and becomes obligated to make the loan, or sometimes after closing. So the lender, if it does it after closing, then that means the lender has fully underwritten the $10 million commitment and closed on the commitment, but then wants to go hedge some of that risk by finding another lender who can come in to take a portion of that loan. So we'll call it a third of that loan amount. And so, if the lead lender chooses to do that through a syndication, then the difference there is that the other lender, so the syndicate co-lender, and there's a reason it's called a co-lender, is because they are both, if there's a note, they would both have their own note, meaning they're both directly, the borrower has executed a note directly to and for the benefit of each of those two lenders. Whereas in a participation, the lead lender remains the only lender with a note or a direct borrowing relationship with the borrower, but then it will sell down a portion of its commitment to the participating lender through a participation agreement, as opposed to having a direct contractual privity relationship between the syndicate co-lender and the borrower. And so, what are some of the reasons that the lead lender would want to do that? We talked about mitigating risk and spreading out some of the exposure. Another reason it might want to do that is, it can be a way to create additional revenue for the lead bank. So, if the lead lender is getting a 1% origination fee on the loan amount, it could go and sell down, basically offer less than the pro rata share of that origination rate to the co-lender or the participant bank, and then keep some of that delta there for its benefit. So there's reasons to do that in addition to just mitigating risk. Why would why would a lender also want to, maybe if the loan is becoming troubled, the borrower is showing signs of distress or default, why would they want to then potentially sell down some or all of that loan? And one of the reasons for that is maybe the lender realizes that it's going to be difficult to exercise remedies in a way that will allow it to recover some of the risk or some of the exposure. And so there are people in the market who will take on risk if the price is right. And so some lenders choose to do this, because they don't want to go through a lengthy process of chasing down the borrower or the asset. So foreclosure, for example, if the asset is real estate collateral. And some banks just have a stance that they don't like to take on real estate assets through an REO type scenario. And so they would rather just go sell down in a distressed market the loan to avoid that. There could also be reasons to do it from kind of a bank's liquidity standpoint. Maybe they just need the liquidity, or they need to open up exposure for that relationship. So you see this frequently, like particularly in like the real estate investment market, where if a bank has $100 million out to a given developer, they may need to create some more room so they can go make another loan to that same developer because they have legal hold limits or lending limits with that relationship. And so they'll go syndicate out portions of the relationship just to create some room there. So different reasons to do that. And also I should mention that, and I circulated a case around just before we started this webinar. This is a long-standing, back in 1990, the U.S. Supreme Court issued an opinion that loan sales are not securities, so they're not governed by the SEC in the way that the sale of securities are. And so as long as, and we're speaking in the commercial context when I say this, that's what this case speaks to. That's also what I think it's Kirshner case that I just circulated that was actually just decided last month by the Southern District of New York, U.S. District Court. And the reason I circulated that one, not that it's of more import, obviously, than the U.S. Supreme Court decision, but just because it's so recent, and I think it gave the LSTA, and we'll get to what the LSTA is in a minute too, if you're not familiar. I think it gave the LSTA an excuse to host another webinar and kind of do a refresher on that concept and what that means for their industry. And so anyways, interesting that this Thursday, they're actually doing a webinar on this exact topic relating to the recent Kirshner case. So, we've talked about how and why a lender might sell down a portion of the loan commitment. And so typically, and this is, so I've mentioned the LSTA, that process typically is, and I don't want to say governed, because the LSTA is a trade association. So it's the Loan Syndications and Trading Association. So it's not like the SEC, or the OCC, where it has actual governing authority for loan transactions of this nature. But what it does do is it promulgates guidance and best practices. And frequently you will find, especially related to syndications and participations, that most of the lenders are incorporating verbatim what the LSTA suggests as their guidance for how those transactions should be governed. So in a big beefy credit agreement where you have syndication provisions contemplated from the get-go, those many times with a lot of our clients are taken on the guidance from STA as to how to manage those relationships. So the agency provisions, as they're often called in that scenario, those speak not to the relationship between the lender and the borrower, but between the co-lenders. So if you have multiple lenders in a loan commitment relationship, how are they contractually obligated to conduct themselves with one another? That's what the agency provisions, as promulgated by the LSTA, speak to. So what you'll typically find is there's a provision of kind of required lenders is a lot of the times how it's defined, and there's different ways to define it, but what percentage of the lenders have to come to an agreement as to certain material changes to the borrowing relationship. So typically things like if you're going to extend the term of the loan, if you're going to increase the amount of the loan commitment in the aggregate that these co-lenders are required to meet, if you're going to forbear or take other actions with respect to a default, including exercising remedies, those typically required a certain percentage of the required lenders. Frequently, you'll find that to be 2/3, which is why earlier when I suggested that we'll have a 1/3 participant lender or syndicate lender come into our example of $10 million. Typically, you would find that that number is 2/3. If you have two or three or more co-lenders, although sometimes in the two lender sense, most of the lenders, if they have sufficient wherewithal as a syndicate, they're going to want they're going to want a bigger seat at the table. And so in other words, greater than a majority, so 50% or more, or unanimous, in other words, meaning each of them have to agree that this is how we're going to deal with this borrower if there's a problem. But sort of getting back to the example, how can this create problems for the lenders and or for the borrower? Well, I mean, what you'll see sometimes, and not all that infrequently, is a lead lender may have more desire to work out the loan with the borrower because that's their primary relationship. So that's this borrower, this company, or this real estate developer, that's one of their customers of the bank. Whereas this other syndicate lender that they've brought in or participant, they don't really have a direct relationship with the borrower. This is just purely to them an investment. And so they're viewing it differently and not in the long-term stance. So sometimes you'll find where the lead lender is willing to say, hey, I'm willing to forbear and enter into a forbearance agreement and give this borrower time to work this thing out. And the co-lender says, nope, not interested in that. We want to either exercise remedies, find a way to force this borrower to correct the defaults or to get out of the relationship, to refinance the whole thing. Or they'll just tell the lead lender, if you want to deal with this borrower so much, then why don't you just buy back our commitment and you can go do that. And so you'll see that happen sometimes where the lead lender sort of has to take it on the chin and go buy back at par, so at full value for the co-lender, the relationship back so that they can work out the relationship and not lose their customer in the process. So that's one way that it can affect sort of the co-lenders. And there's a whole litany of, like we've talked about, the agency provisions that would speak to this. From the borrower standpoint, as you can imagine, if they have a good relationship with the lead lender, but the participant or co-lender isn't interested in a workout, well, then that can really create problems for the borrower in the short term, where they could be having a liquidity problem where they need access to the loan dollars, to the commitments, and they can't get them if there's a required percentage of the lenders who have to decide on a workout strategy because the borrower's in default. It could really create problems for the borrower. So just a couple things to think about there. The other thing I wanted to mention, and before I transition this to Dan and let him talk about the next steps in actually selling a loan and how you do that, we've talked about the LSTA and how it governs the primary market for loan sales and the agency provisions like we've talked about. There's also a whole secondary market for loan sales where lenders can then sell down further sort of exposure of the commitments to other industry participants, not even other lenders or financial institutions. So you'll find hedge funds, and these are typically transactions, I would say, that for the most time are distressed in some way. Now, that's the way we would think of it in kind of the general parlance, that they're distressed. There's also a whole sort of set of rules or it's rules in quotation marks here, because like we've talked about, the LSTA doesn't have any real authority, but there are rules that relate to these transactions which define whether they should be documented on a par or near par documentation, meaning the borrower is actually in pretty good standing with the relationship and they're making their payments as they come due. And then there's a separate set where they should be documented on the distress set of LSTA secondary loan documents. And those you'll frequently find as part of a bankruptcy or a receivership proceeding where they're trying to get whatever um, whatever revenue they can, and the bank just wants to exit this, so the lead bank just wants to exit this, and they can find these secondary markets where people are willing to take on the risk of under that loan transaction, but they're going to want to do it at a steep discount to what the primary bank. And so you'll find somebody coming in at to buy it at 50% or less of the outstanding principal balance, and assume that note, and then take on the risk with either. And the reason that they would want to do it, these participants are either A, through their due diligence, they think this borrower has a chance to turn it around and actually make the payments. And so if they're buying it at a steep discount and then they're going to get paid off, well, they've really made some money there. Or B, they don't care because they like the assets, and so they just want to acquire the assets, whether it's a company's assets or real estate collateral or the business itself, because it's a strategic play for this the buyer of this note. So you'll see that market too. Similarly, like we talked about with the primary market, these are also not securities. I would say that these transactions, based on my experience from back, the last time we had a downturn, you find lots of litigation around these issues because lots of these industry players who come in to buy these distressed notes, they will find themselves not honoring the deal if the deal is not in the money for them. And so these were ripe for litigation, 10 years ago or so. And so we may see a return to that in the next few years. So just be keeping an eye out for that. And if you have clients who are engaged in this on either side, whether as a lender who's selling loans down in the secondary market, or if you represent a hedge fund or another kind of, I would say, sort of more risky financial institution who engages in these transactions, definitely ask them about them because it could be a good source where they need some help. And it's kind of the Wild West. I mean, some of these trades, the par and near par trades, can be booked verbally over the phone, and it's a binding transaction. Whereas the distress, there's a little more documentation there just because the risk is higher. So yeah, Dan, you want to take it from there, and I'll advance the slides for you.
Yeah, thanks, Derek. I think that's a perfect segue into talking about what these loan sales look like. And as Derek said, there is a world of difference between loans that are in default and loans that are not in default. So lenders, as we said, typically originate loans to hold them and receive, the fee and interest income that comes from them. Once the loan is in default, the goals of the lender really shift to seeking a return of principal to the extent possible. And so most lenders, and I'm sure you're seeing this as you watch these presentations, but most lenders understand that collecting on collateral, collecting judgments, all of this takes time and a lot of money because we're very expensive, and it's a long process to work through the courts, to work through foreclosure proceedings. And so as lenders are weighing strategies to recover principal, an alternative strategy is just to liquidate the loan to a buyer who's interested. And so, as Derek said, post default, these buyers fall into two groups. One, folks who want to come in and restructure loans and get a return over time, or two, that they love the collateral so much that they would be more than happy to take that collateral. So for those buyers, they have to be willing to accept a great deal of risk as part of this. And the other thing to keep in mind too, and this is especially true in the real estate context, is there is a market out there for selling loans that are junior loans for redemption rights. And so back in the last downturn, I sold a lot of HELOCs and second position mortgages because folks wanted redemption rights and foreclosure. So there are a number of different ways that these loans can be bought and sold post default, but as Derek pointed out, there's a lot of risk associated with buying a defaulted loan for a buyer, and the uncertainty associated with how the collection remedies are going to work out, the true value and condition of the property, because typically the lender's not going to have the ability to visit the property or appraise it except for like a drive-by appraisal, the possibility of bankruptcy. And so we're going to, in the next couple of sessions, talk a lot about bankruptcy risks and what that means. And all the delays associated with this create a lot of additional potential carrying costs and time and effort for a buyer. So, time is money, and the seller and the buyer in these defaulted scenarios are always kind of weighing risk and return. And so the biggest issue that folks need to come to an agreement on is price. So when you're thinking about, the customary terms, the first thing is price and getting to a price that both the buyer and the seller can agree on. So structurally, loan sales work a lot like any other sale. So for folks from like the real estate group, it's very similar to a purchase and sale contract. You can either do a sign and close where everything happens at the same time, or you can structure it as a purchase contract where you have a contract signed, you put down a deposit, an earnest money deposit, and then you go through your due diligence, and subject to the satisfaction of certain conditions, you close. I think one big difference between most other sales that you're familiar with is that loan sales, both pre and post default, are almost entirely as is, where is. So, a lot of the topics that Derek talked about early on in terms of file review are incredibly applicable in this context, because once you buy that loan, you really don't have a lot of recourse to the seller, if any. And so you should expect some basic reps and warranties about ownership, namely that the seller owns the loan documents free and clear of liens, that the seller has authority to enter into the purchase agreement and sell the loan documents, and possibly the principal balance of the loan. But that's about it. And you can think about all the other things that you might like to ask for if you had no experience in this area. You might want to know, are there any defaults? Does the borrower have any counterclaims? What does their payment history look like? You're not going to get any of that. And so I think if you kind of come into this with the idea that, due diligence is king, typically the bank makes the entire loan file, or the lender makes the entire loan file available to the buyer. And you go through the process that we've talked about early on. You look at their diligence regarding the borrower, regarding the collateral. You look at their org docs, you look at title, if it's real property, or searches. You do new searches on the borrower to make sure they're not bankrupt, to make sure that there aren't any intervening liens. You look at payment histories, you look at default notices if they've been sent out. You look at the reporting that's required under the loan documents. How is this borrower doing? How is their property doing? How is their business doing? And you look at the loan documents themselves to make sure that they make sense, that do you have legal opinions? And one thing people miss is that most loan documents are freely assignable, but there are certain loan documents that may or may not have certain consent rights or limitations on assignment. And so you always need to make sure that the loan documents are in fact assignable to the buyer. And so the other thing to keep in mind too is that most banks, both as a matter of common law and statute, have confidentiality obligations to the borrower. And most sophisticated transactions will require you to enter into a confidentiality agreement as part of the acquisition. So typically you do the confidentiality agreement, you start negotiating the purchase and sale agreement, you go through the due diligence process. And at the end of this, there are a lot of things you may not know, and you might like to know certain things from the borrower. You might like to cover off certain risks that the borrower has counterclaims against you. And so there are ways to do this, and so I think I just kind of want to do a little sidebar. Maybe Derek, if you could flip to the next slide. So there's a big distinction between the kind of par, about par, and kind of distressed world because of Article 3 of the UCC. And I'm going to take you all the way back to the bar exam for some of you. Like I see Lynn Butler, that may be longer than others, like Adam Roundy. So I mean, under Article 3, you probably remember there's this whole holder in due course concept. And much of the securitized loan market exists almost entirely because of these types of protections. So, in other words, if a loan is non-default and the lender buys it for value in good faith, without notice that the instrument is overdue or been dishonored or that there's a default, and without notice that it's basically been forged or altered, or without any notice of any claims or defenses that the borrower may have, the borrower is basically barred from asserting all sorts of contract defenses against that successor lender, other than kind of basic formation defenses, that I wasn't old enough, duress, fraud in the inducement, illegality, lack of capacity, or I got discharged in bankruptcy. So it really limits the scope of backward-looking claims that could exist against a buyer of a loan. Now, in the distress market, the assignee of the loan takes subject to all those potential claims. And so what you do, and so some of those can be addressed post-closing through loan restructurings, either temporary or permanent. I mean, Derek talked about some lenders like to come in, buy loans at a discount and restructure them. As part of that, you can get all of the same waivers and reps that you would get in a loan workout. So, we talked about forbearance agreements, we've talked about amendments, all those same rules potentially apply to a new lender who buys that loan. So, this seems like an obscure topic, but it in fact all fits together. So you bring those same workout tools to bear as the lender and try to mitigate some of those borrower-related risks. Now, if you can flip to the next slide, Derek. Now, assuming that you get through all the due diligence, you're happy with the loan, you're happy with the borrower, you're happy with buying it at the price you agreed to, this is one of those things where possession really is 9/10 of the law. So the first thing you get is you get the original loan file. In particular, you need that original note, and in many jurisdictions that's necessary to show, standing. There are a number of cases out there from the last recession about, the show me the note cases, where borrowers would come and ask, lenders who had securitized their loans, show me the note, show me you're the holder, show me you have standing to sue me. And so taking possession of the original loan documents is critical. And then the rest of it is really just an assignment of contracts, but very specialized contracts. So because a promissory note is a negotiable instrument under Article 3, you need an allonge, which is basically a separate page, but it's an endorsement to the back of the note. As you may recall, these can be either done with recourse or without recourse. In these scenarios, they're always without recourse. So you wouldn't have a claim against the prior lender as the endorser. There is usually some sort of general assignment and assumption. Derek has given you a form, but you want something that says that all of the loan documents, all of the ancillary documents, the title policies, everything has been assigned to you as the buyer. And the last thing is you'll probably have some specialized assignments. The most common one is, of course, the recordable assignments of the deed of trust, and sometimes if there's a separate assignment of rents. So you can record those in the real property records, put the world on notice that you are now the successor lender. At least in Colorado, it's not necessary, but it's always a good idea, because once you do that, you'll get notices from other lien claimants or others, of potential real property related items claims, taxes, things like that. So the other thing too that I think people forget a lot is, you're going to have to file an assignment of the financing statement that's going to exist with the loan. Very easy under file UCC3, but that is sometimes thing people forget. And I think the last thing that is obvious when you say it, but people forget this as well, is that you are transferring the servicing of the loan. And so you need to send out what are known as sort of hello and goodbye letters. So you have to tell the borrower where to make their payments now, because they are not making payments to the prior lender. They're making payments to the buyer as the successor lender. And these can get complicated when you have loans that are complicated, such as loans with cash management structures. So you're going to need to work with cash management banks and lockbox banks to get those transfers done. It may require transferring to a new bank entirely. If the loan's being serviced, you may need to transfer servicers, because many of those servicing agreements terminate on transfer. So there may be a whole lot of ancillary paperwork that's required simply to transfer a loan from to a new lender. And I think it's good to remember too that, in the residential context, there are special, 10-day notice requirements under RESPA for transfers and things like that. So you have to be very mindful of the servicing transfer and make sure that it's handled correctly for the buyer client. So, and Derek's provided some forms. We did want to note that these are specifically real estate oriented, but the same principles apply to any loan purchase and sale. So that's really kind of the end of the transaction. We're a little bit over, but if folks have questions, please feel free to unmute and ask them.
Question, Dan,
Yeah,
from Carrie. It looks like Carrie asked, what happens if the original note is lost?
That's a great question. So the answer in the typical context is that you can, in most states, you can get a lost note bond and continue forward as if you are the lender and complete a foreclosure and things like that. In this context, I would have a really hard time buying a loan if the seller said to me, hey, the note is lost, because how do you know they're the holder? And so, it goes back to this whole like endorsement holder in due course concept. At least in Colorado, I think a successor, because if you're not a bank, you need to present the original note to the public trustee in a foreclosure. I think buying a note and getting a lost note bond, or trying to indemnify as to whether there's a conflicting owner, would be very risky. Because the risk is, go ahead.
Sorry, go ahead. I was going to add to that. I mean, one point you may make as the buyer is to put that on the seller, and so hopefully the seller's loan documents have further assurances or cooperation provisions where the borrower is obligated to execute a new note or an amended and restated note if it's lost, and so put it on them to go fix the problem, especially if it's a borrower who sort of doesn't have anywhere else to go and they're sort of looking forward to the loan being worked out. I would put it on the seller and say, you fix this problem and then we'll buy the loan from you.
Yeah, I think that's true. And I think in the syndicated context, you may have more options, because usually there are fairly robust provisions about the borrower re-executing notes and providing new notes if an affidavit's presented that it's lost or destroyed. I think in just kind of the routine single bank market, though, kind of middle market community banks, that would be a big issue. Well, if anyone has any more questions, Derek and I are always available to talk about this. So yeah, thanks everybody for your time, and hope you have a great rest of your day.